to us, it's really about being able to identify the current market environment and what solution can we offer to produce optimal time return consistency. And so I don't think that anything set can ever be an optimal solution that will offer some decent longevity.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello and welcome to Better System Trader, episode 109. Thanks for showing up to have a listen, and today we're going to be talking about adaptive trading systems. The markets are in a constant state of adaptation. Conditions change, strategies fall in and out of sync with the market, causing periods of good and poor performance. So what can we do to improve consistency by making our systems adapt better to changes in the markets? Our guest for this episode is Brian Miller from Optimized Trading. And in our chat today, Brian is going to share a number of insights with us, including why implementing adaptability into strategy design is so important, and some techniques that you can use to create adaptive systems today. We're also going to discuss why market classification needs to be considered and the types of approaches that you can use to classify the markets. And Brian is also going to share how to pursue a multi-model structure that adjusts dynamically to changing market conditions, plus much more. Now, I should also mention that this recording is the first of two parts. The second part will be available very soon, so look out for that one. Anyway, let's get into it now and head over to our chat with Brian. Hi, Brian. Welcome, and thanks for joining us today.
Oh, glad to be here.
Now, I'm really excited to be talking to you today because when I was doing my research, I read through all of the blog posts on your website, actually, and I found a lot of really interesting and creative ideas. So I'm really looking forward to discussing some of those with you today. But before we get into some of that, how about we start with a little bit of background on yourself? Can you share a little bit of background on how you got started in the markets?
Sure. Yes. So I have a background in electrical engineering. Started trading during the crash of 2008, which was a good time to dive into the specifics of risk management. So started trading around that time. Actually started out with FX markets. I didn't know much. It took a lot of trial and error. But I kind of got lucky with market volatility in some respects. After I traded FX for some time, I wanted a new path to follow, and so I began focusing on trading the E-mini S&P 500. So I've been doing that ever since. Actually, we focus more so on drifted market types, i.e., no FX.
Yeah, okay. So how then would you best describe your approach to trading the markets today?
Oh, wow. I would say to never place any weight on any perspective of singularity, no matter how robust something has been historically, to never fully rely on anything of singular nature. As we all know, the markets are in a constant state of adaptation, and so many traders and developers tend to use some type of performance metric formula to identify outcome consistency or the underlying robustness of the alpha or beta. And so, really what that comes down to is just you choosing an independent input combination, because typically if the underlying strategic model or concept is truly robust, usually we all know that it'll offer a wide range of input options that will typically meet your performance objectives. And so then you kind of twiddle down and somewhere in the middle and try to choose one, or really that's just picking one from the lot. And so, we like to, develop many independent models designed for specific market environments and substructures. And then include them within a more adaptive and intelligent control module. which can identify current and market environments, along with it tracks independent model performance relative to market environments and substructures, as well as correlations to other models themselves.
All right, well, I might ask you about that multi-model systems a little bit later, but first, can we just have a chat about adaptive systems? I know, well, as you mentioned there, you know, adaptive systems is one of the key components in your approach to the markets, but so why is it so important that you design systems that can adapt to the markets?
Right. Well, try to think of it as throwing a stone into the river and trying and expecting the stone to mimic the flow. Really, I mean, that's the simplest way to really explain it. You want even though the underlying concept itself may be kind of set, you want how it comes in and catches the market, how it analyzes the market. You want that to be able to adapt to it. I.e., no set stops, no set profit targets. Everything is based on price activity, along with a lot of times you'll have correlations and patterns with how your market or how your model reacts to the market. And so internal correlation and efficiency analysis is definitely a big win. Being able to internally analyze how accurate, how efficient a signal may be, or an underlying analysis concept may be at that time. Because not every concept works in every environment. You have to be able to depict periods in which it gives a higher probability and be able to adapt to the optimal solution.
Yeah, okay. So how about we dig into that a little bit further? So how can you actually, or what are some techniques that you can use to implement adaptability into strategy design?
Sure. So, even with some of the more, like TradeStation or multi-chart trading platforms, there's some workaround solutions, some custom functions. I believe actually Murray Ruggiero developed very simple to implement that'll give you the ability to, and that's if you want to develop strictly within TradeStation and multi-charts and not, deploy more advanced machine learning within Python. But to be able to internally capture model performance, and then you can analyze that model performance relative to other models, relative to the market environment. So I think that, one, obviously not deploying anything set in stone as far as set stops or set profit targets, but also dynamic analysis methods that can switch, if an underlying concept is somehow measuring variations of momentum, to be able to depict which variation of momentum is best suited for the current environment. So to us, it's really about being able to identify the current market environment and what solution can we offer to produce optimal time return consistency. And so I don't think that anything set it can ever be an optimal solution that will offer some decent longevity.
Yeah. Okay, so in that case, the dynamic analysis you were talking about then is basically classifying market conditions.
Sure.
Now, there are a number of different ways that you can classify the market. What type of approaches do you like to use?
Actually, we really like to look at historical patterns. We break everything down to absolute microanalysis methods. So you're looking at how many, for instance, a typical or a generic momentum calculation is close minus close length divided by length, right? When, what is the size behind that? What is the force behind that? So we like to identify, for instance, historically, how many up bars are in an uptrend, how many down bars, how much cumulative up volume, down volume, how much price is within that movement, what happened the 5 or 10 days preceding that move. And so you go to points in time when you see, obviously points in sentiment change and or support or resistance, and you try to identify what may be going on there, what changes may be occurring to try to identify, what optimal solution can you apply during that period going forward. We like to really, with us, it's really just historical patterns and then implementing that and combining it with a weighting mechanism of real-time analysis. So, and how those also change throughout time, because even though, for instance, price characteristic has somewhat like a stochastic range to it, you can sometimes be able to identify each market environment may have a different characteristic. So, to us, it's really just trying to match a solution with the characteristic that the market is exuding.
So outside of market classifications, are there other avenues you can apply dynamic analysis into trading strategies?
Yeah, sure. A favorite of us actually is, the structures that we set in place, the multiple model and multiple entry. Not just simply the model development, which is crucial. It's just 10% of your entry, when you're going to enter, when you're going to exit, but the money and risk management aspect, right? And so I think one of the massive benefits of deploying multiple entry concepts, being able to step into positions, first of all, it diversifies the factors which produce outcome, right? So you don't have to choose between, are you going to exploit random variations of value or cyclical variations of value? So you can actually exploit both within a single construct. But also with that, when you allow multiple entries, and you're not limited to a single share or a single contract, that gives you the ability to apply multiple layers of intellect, of all the research that you've gathered, of all the patterns that you spotted, and how each model tends to perform in its identified condition. For instance, if you identify market environment, let's say you label it 10B, right? So you develop model 10B for that condition. But model 10B's money and risk management settings could be vastly different from 10C or 11A or what have you. So, I think that dynamically controlling how many shares per entry, how many entries you're allowing to exploit both the random and cyclic signals, on a per environment basis. So one way to test this is simply just using the eye test, right? So you can go back through and identify major market environments. For instance, 2009 to currently is a pretty good uptrend. So you can develop a model for that environment, but within that, you obviously have some substructures which could result in a few submodels. For instance, 2015, you had a good healthy dose of volatility and some increasing cyclical moves. So I think being able to apply the dynamic kind of mindset or philosophy within money and risk management is very critical to improving the longevity and outcome consistency is by far, which also usually results in good trade frequency. And that's a critical aspect as well, because it increases the data points for internal analysis. So, and for those who like to compound, obviously, it helps the money and risk management also compound as well. So I think that overall, people tend to look at the entry logic and apply a much heavier weight to that than what is justified. Obviously, it's critical, but for each model that we develop, there's 7 independent exit models attached to that. Typically, anywhere from 6 to 7 different exit models. Some of them are profit only, some of them are loss only, and some of them profit and loss is not even configured. It's just times when that model should not be in the market, or it's not offering a good opportunity. So
if I understand you correctly, you just said that you use a single entry technique and then you try lots of different exits. So did I understand that correctly?
Okay, so the first entry, for instance, one of our current products, the OptES V3, that allows up to 3 entries, right? 1 contract each. We're kind of limited through our distributors, but the model is developed with a single entry, which exploits random variations of value. Number 2 and number 3 is more cyclical in nature. But however, each is a system all of its own and could be traded as a system all its own. But when you pair them together is when you really start to really improve the time return elements there. So I think that, how models perform, or the initial entry or combined, not using money and risk management to be the sole justification as to why the system produces well, but you want the underlying strategic concept to be the justification. It's also critical within the R&D phase that you never allow compounding. You always use set shares. And then once you find, whatever best fits your performance objectives, then you can move forward with, dynamically adjusting that and implementing some type of a very systematic and very slow integration of compounding effect.
Okay. So if you're building models for specific market conditions, is there perhaps a risk that the over-optimization could creep into there, or is that not really a concern?
Actually, yes, there is. But you know what? I think when it's definitely a very popular topic. I mean, everywhere you go, every quant you ever speak to definitely speaks about overfitting. However, one of the main benefits of a multi-model or multi-strategy systematic structure is that when you design a CS models, or condition-specific models as we call them, you want a close fit, right? As long as, one, it's producing good trade frequency for its design condition. Two, it offers a good payoff matrix, meaning that condition lasts for some significant amount of time. For instance, like for a daily or a 40 minute bar, you want to develop models for conditions that at minimum last for 3 months at a time, and is very repetitive in nature. So trade frequency, keeping the law of numbers on your side, is a good thing in many respects. But that said, if that model, for instance, falls out of favor, or its correlation reduces, typically you'll have another model there that's correlation is coming into strength, right? And it's not always a negative switching situation. For instance, I get this question a lot. Well, what's the point in developing multi-models if you're just waiting for one to fall out of favor and then you're just going to activate another one? Why not just run another optimization, just apply the same variation? And so, when internal correlation efficiency analysis and predictive and reactive measures is important to implement all of them. And so that way you're not relying upon simply reacting to a negative switching situation. So a lot of times you'll have conditions that exist when, the model 10B, for instance, may be activated and may be performing okay, right? But a model 12C may come along and start performing much better than that. So obviously your control module would identify that and switch to it. So it's not always, you're waiting for some type of drawdown to occur, or you're waiting for, a significant loss to occur, or even a reduced correlation strength. So did I answer your question?
Yeah. Yeah.
Okay.
Yeah. So if you're building these models for specific market conditions and they start to break down, do you perhaps think that maybe it's time to re-optimize them, or maybe they're not really suited to that type of condition anymore? Or How do you manage that those developments in your portfolio?
Sure. So, like I said, even though you want a close fit, and the risk of that falling out of favor in the market is increased, it's not that big of a deal, because you have other thoroughbreds in the stable. You're not dependent upon that like you are with a single system structure. And so I think one way to mitigate those risks, obviously, is that the underlying strategic concept should always be, I call it the trifecta, right? Quantitatively, technically justified, fundamentally, and behaviorally. So, and that's one reason why we primarily stick with drifted markets, large cap, dividend stock, sector index, smart beta ETFs, and index futures. So these markets are fundamentally and behaviorally justified on many, many different levels. And actually, one of the main underlying concepts that we use to generate several of the models within our IMM control module is extracted from a specific type of stock analysis that we can apply across multiple asset classes. So, however, I do think when one goes about pursuing a multi-model structure, it's also important to include completely different strategies or underlying concepts, and that way you're kind of diversifying and not just variations of the same. And so just trying to really apply the same mentality that a portfolio manager does to a portfolio via diversification, but you're doing that on a systematic per market level.
Yeah. So you've kind of already touched a little bit on how you manage these multiple models and the controls that you use there. But for people, or for traders who are starting to build or want to start building these type of model management modules, what would you recommend they do to get started there?
I think that, like I said, I can't pronounce his last name correctly, but I think it's Murray Ruggiero offers some custom functions. They're quite cheap, quite available written within EL that can be applied to multi-charts or TradeStation platforms that will give you the ability to very easily develop multi-model structures, track the independent historical and real-time performance of those, and be able to construct the multi-model structure. It may not be able to deploy some more of the advanced, machine learning concepts that would be available within like Python, but you'll still have the ability to easily create a multi-model structure and, performance analysis. And, there's some, the majority of which can be done within EL, as far as performance correlation analysis of how models perform relative to each other and obviously relative to different market conditions.
Yeah. Now, a few minutes ago, you just kind of touched on behavioral finance and how to implement those type of concepts into trading. So can you just give us a little bit more information on the type of things that you look for there?
Sure. Really, with me, it's not so much individual traders mentality. A very popular conversation lately is sentiment analysis and implementing stock tweak data and mood data and social data. So with us, it's more on a general, broad institutional level. And so with us, we tend to look at a very specific type of large cap dividend stock, which portfolio managers mainly have two types of strategies that they deploy. One is a growth strategy. When they see the market has more growth potential than it does risk, then they rebalance the portfolio into quote unquote growth stocks. However, growth stocks come in and out of favor, very frequently, except for the majors, of course. But so it's easier for us to identify and analyze the quote unquote protectionism strategies, the stocks that are invested in when portfolio managers see increased risk, increased volatility, and declining fundamentals. So, for instance, large caps such as Johnson & Johnson, Kellogg, General Mills, Walmart, companies like that. If you group them together, a lot of the consumer staples, if you group them together, you'll definitely find some correlations with the S&P that has a very organic way of keeping you out of economic conditions with systemic risk.
Yeah. Okay, thanks, Brian. Now, I just want to ask one final question now before we start wrapping up. So, throughout your blog post, there is, I guess, an underlying theme that traders need to be creative and try to look at markets in unique ways. So,
Sure.
How do you actually tap into your own creativity and come up with unique ideas to test?
First and foremost, it's time. It's trial and error, being an absolute workaholic and loving what you do. All right. So, if you have an idea laying in bed at 2:00 in the morning, get up and pursue it. And, sometimes your idea, it couldn't be worse, right? It absolutely, it's a 90-degree equity curve down. And sometimes simply reversing and doing the opposite will just be mind blowing. But I think that, for instance, going way beyond what's accepted with the quote unquote traditionalist perception of what a strategy should and shouldn't be, such as, your risk return ratio, set stops, set profits, and also going way beyond the regular functions and analysis methods that are given practically on every major platform. For instance, I think I already mentioned like the general momentum calculation, right? Mm. So, I think breaking everything down to, if you want to analyze momentum, analyze all the momentums: price, upward movement momentum versus downward movement, volume momentum, sentiment momentum. So breaking everything down and then, trying to find ways that it kind of fits back together. And sometimes it doesn't. And sometimes you'll find that certain things are much more valuable than others. And usually, don't be afraid to go against, the market's perception of how things should be. And so I think that we've actually built the majority of our concepts. When you drill down to the entry logic, it's reverting in nature. So even though that we use, obviously, multiple frequency, directional bias calculations, obviously we want to buy at multiple variations of value. So I think that going against market direction, it can pay off much more than going with the herd. It's very hard to get ahead when you're following everyone else. So,
yeah, I think I know when I was reading through your blog post, you had a lot of really unique ideas in some of those articles. So I added a lot of ideas to test to my own list. So thanks for that. You've just given me more work, but
good.
But I do recommend people go over and have a look at your website. I'll post a link from the show notes page and go through and have a read through some of the articles. You've got some really unique ideas and insights in there. So I think that's really good. So I hope you don't mind me sharing that with everybody.
No, not a problem. Yeah.
Okay, awesome. Well, I'd just like to start wrapping up now with some quick closing questions. The first one, what's the biggest lesson you've learnt through trading?
Oh, wow. Pursue everything to the end. Definitely, if you have an idea, pursue it until it validates with profitability or loss. Never quit something halfway through. Always, because if you don't, it'll nag you. It'll nag you till the day that you die.
I guess, though, the next question to that is, how do you know you're at the end?
Yes. Well, that's very simple. You either see a good equity curve or you don't. And so, a lot of times, you can usually see if you're on the right track from the get-go. It may take a few small adjustments here and there, but, I think also, when someone has a frame of mind that they think of how they should develop a system. For instance, you see a lot of conditional statements, right? Or filtering mechanisms. So, you want condition 1 to be true, condition 2 to be true, and condition 3 to be true. If all 3 is true at the same time, then you want to buy at XYZ calculation price, right? When, to be honest with you, a lot of times sequenced events are much more robust in nature. Things that happen within a certain sequence or within a certain amount of time or price or volume that may not be true all at once, but they have been true, within the past few days or what have you. So I think definitely trying to, it's such a generic term, but quote unquote, thinking outside the box, but just trying to always push yourself to look at things and perceive things differently, and just pursue it to the end. And if it validates, great, and if not, just start over. Because if you love what you do and you're dedicated, I'm sure like you and I both are, you always have a book full of ideas and concepts to move on next to.
Yeah, absolutely. Speaking of books, do you have any favorite trading books?
That's funny that you should mention that. Not really. I've read a few trading books, to be honest with you, but I think that I had a few very important mentors in the world of trading, which I think is, everyone should have a really good mentor in their life, at least one. And then when you get to a level to where you're successful, you should really reach out and be a mentor to someone else, because it's life changing. It really is. I've had several in the world of programming, and then also several in the world of trading itself, and that's critical. It's a good human cause. It's a good gesture to someone, because it can be life altering.
Yeah. Okay, and now what about what's the best way for listeners to get in touch with you?
Sure. Yeah, you can reach me at my email address at Brian with an I at optimizedtrading.com. I'm also on LinkedIn, which I check regularly. So two means of identification and contact. So anybody has any questions about our concepts, our products, services, etc., you're more than welcome to reach out.
Yep. Okay, cool. And if anyone's interested, the website optimizedtrading.com has a lot of interesting blog posts on there, so go and check that one out too. Highly recommended. Okay, well, thanks so much for your time today, Brian. Now, is there anything else that you'd like to mention before we finish up?
No, that's it. Thank you very much for having me. I appreciate it.
Awesome. Well, thank you very much for spending time with us today. It was really great chatting to you. So thanks again, and all the best.
Thank you.
Cheers.
Take care.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.